An MBBS today costs 1.5 crores and an MBA abroad goes 2 crores and above. If you don't plan early for your child's education, inflation will plan the costs for you. In today's video, I'm going to break down child education financial planning into 5 very simple parts. First, how much higher education actually costs and what are the realistic future estimations. Second, an overview on all the financial products that you can use for your child's education planning. Third, mutual funds. Fourth, insurance. And finally, my conclusion on what you should actually do. An MBBS degree today costs more than 40 lakh rupees per year. That means you are looking at 1.5 crores for the entire course. And this is today's cost. It's not 10 to 15 years down the line. When I first saw these numbers, even I was really shocked. But it became very real when one of the doctor clients told me that he was actually investing to build a 13 crore corpus for his 2 children. So when they become doctors, they want to become doctors, he does not have that financial pressure. 13 crores for education, let that sink in. Now, when I showed the same projection to another client who's a VP in marketing, he simply could not believe it. He didn't disagree, but he was just not aware of how expensive higher education could become in future. As a CFP, whenever one client gives me a new perspective, I make it a point to share that awareness with other clients as well. It's not just about MBBS. Even MBA today costs a bomb. Top colleges in India and abroad can easily run into crores. And I don't want your lack of awareness or delayed planning to cost your child a brighter future. But before I begin, I just want to tell you something. Hurts more is when you had that capacity, earning capacity, you had the time, you had that opportunity, but you just didn't plan properly. And because of that, your child misses out. That regret stays much longer than the financial losses. So let's talk about how to make sure that that never happens. If you are thinking of higher education and it will cost you around 25 to 30 lakhs, you are planning for 2015, not for 2036. Let's break this down calmly with real numbers. Let's start with Indian metro cities like Mumbai or Bangalore. Today, a good private engineering college, business or specialized degree will cost you anywhere between 10 lakhs to 25 lakhs per year in just tuition. Top private institutes or universities are already at a very high end. Add hostel, rent, food, transportation, books, laptop upgrades, project costs, another 4 to 6 lakh rupees every single year. That means currently you're spending close to 15 to 30 lakh rupees on just an undergraduate degree. Over 4 years, you are looking to spend anywhere between 30 lakhs to 1.2 CR depending on which degrees your child is pursuing. Apply 9 to 10% of education inflation. By 2036, the same degrees can realistically cost 1.5 crores to 2.5 crores in Indian metros. And if your child goes for a postgraduate degree, MBA, specialized masters, law, data science, add another 50 lakhs to 1 crore. So even if your child never leaves India, a full undergraduate, postgraduate pathway in Mumbai, Bangalore can easily cost you 1.5 crores. MBBS might even cost you 4 crores by 2036. Now, here's what tier 2 parents underestimate. If you're currently living in Nagpur, Indore, Nashik, Jaipur, your child moves to Mumbai, rent alone today is 25 to 40,000 rupees per month. Food, travel, social living, short-term certification, internships, that's 5 to 8 lakh rupees extra in living costs every single year. This is not luxury. This is baseline urban survival. Now, let's move abroad. Let's see what's happening in United States. Today, international students pay roughly $40,000 to $70,000 per year, including tuition, living at a decent university. That's 35 to 60 lakh rupees per year at a currency exchange rate today. 4 years undergraduate degree today will cost you around 1.5 CR to 2.5 crores. Now fast forward to 2036, with tuition inflation in US running at 4 to 6% in dollars, plus potential rupee depreciating, a US bachelor's degree could cost you 2.5 crores to 3.5 crores. Add a 2-year master's, another 1.5 to 2 crores extra. Total expenditure close to 7 to 8 crores you can assume. And this does not include currency volatility risk. If the rupee weakens, your cost automatically rises even more. Now, in the UK, United Kingdom, London, right, Scotland, international tuition today is 20 to 40,000 rupees per year, depending on the course. Living in the city costs around 15 to 20,000 pounds per year. That's, close to 20 lakh rupees, 35 lakh rupees. So you're already looking at a cost of close to 55 lakh rupees every single year today. By 2036, factoring fees hike, exchange rate movements, a 3-year bachelor's plus 1-year master's in UK could easily cost you 2.5 crores to 3.5 crores. Now let's see Australia. Tuition fees ranges from 30 to 50,000 Australian dollars per year. Living costs around $20,000 annually. Combined, that's roughly 25 to 40 lakh rupees per year right now. With inflation and currency movement, a full degree pathway by 2036 could range 2 to 3 crores comfortably. Now, let's just pause. Most parents are investing in FDs, fixed deposit products that are currently giving you 6 to 7% returns. You are relying on PPF, Sukanya Samruddhi, where rates keep getting revised and long-term trends have declined gradually. Education inflation is running at 9 to 12%. 3 to 5% gap compounded can create a massive shortfall. If your child is 3 years old today and you need 3 crores in 2036, you are not just saving for the fees, you are building a multi-crore inflation adjusted fund. When we plan for your child's future, I prefer building the core portfolio through mutual funds, especially equity-oriented mutual funds, because education inflation, particularly for professional courses or overseas studies, is rising much faster than your regular inflation. Over the next 10 to 15 years time horizon, diversified equity mutual funds or low-cost index funds via SIPs gives you highest probability of meaningful compounding. We can structure it using large cap or flexi cap funds for stability, add in index funds for cost efficiency, and selectively include mid-cap exposure for higher growth. As the goal comes closer, we gradually shift to hybrid funds or the debt funds to reduce volatility and to protect your accumulated gains. Now, the fixed return options like Sukanya Samruddhi Yojana or the PPF are definitely safer because they are government backed, but their interest rates are not always fixed for the entire tenure. They are revised periodically, and over the long term trend, we have seen a decline, gradual decline over the years. So, while they provide stability, they may not always beat education inflation, especially for goals 10 to 15 years down the line. Fixed deposits and bonds also offer safety, but post-tax returns can reduce your purchasing power, but do not rule out these options. In insurance, most traditional child plans are rigid and cost heavy, but they are specifically for protection focused, and there is a special feature. If a parent is no more, the insurance company continues to pay the child's SIP or investment contribution. That feature can be useful purely from a risk management standpoint, provided we separate investments from insurance smartly. And for parents planning to send a child abroad, there are also gift city based investment products that allow international exposure and dollar dominated investments in a tax efficient structure. These can actually help you hedge currency risk and align your portfolio with foreign education cost. So the strategy is very simple. Use mutual funds as a growth engine, fixed income products as stabilizers, add proper term protection for risk management, and where relevant, incorporation of international exposure is needed, so your child's education corpus is both secure and inflation. Let's talk about something really uncomfortable. What happens to your child's 3 crore education plan if you are not around tomorrow? We love discussing SIPs, returns, compounding, but we rarely discuss income interruptions. And that is the biggest risk any financial plan can actually face. This is where insurance companies actually come in, not as investments, not as wealth creators, but as a shield, a protection. A pure term plan is the most powerful financial protection tool you can actually buy. You pay a very small annual premium, and in return, your family gets a lump sum, 1 crore, 2 crores, 5 crores. If something happens to you, no saving element, no maturity value, just pure protection. And that lump sum ensures your child's education continuity. Your spouse will not be forced to liquidate assets, and other financial goals will not collapse midway. Now let's compare that to most traditional child insurance plans. They promise guaranteed payouts when your child turns 18 or 21, but the returns are very modest, sometimes barely beating inflation. They feel safe, they look structured, but they are not designed to create multi-crore wealth. However, this is important. Some child benefit plans offer a special feature where if the parent passes away, the insurer continues to pay the future premiums and the child still receives a majority amount. That continuity feature is very valuable, but it should complement your investments, not completely replace them. The mistake many parents actually make is mixing insurance and investments blindly. Insurance should transfer risk, mutual funds should create growth, a term plan creates certainty, a waive your benefit creates continuity, investments create wealth, and if your child's higher education goal is 3 crores and above in 2036, you cannot afford to confuse all these roles because protection is not optional, it is the foundation of a financial plan. If your child's dream is Harvard, Stanford, London Business School, Oxford, then why are you building the corpus in rupees? That's the very first uncomfortable question you need to ask yourself. Gift City Mutual Funds allows resident parents as well as NRIs to legally invest in USD dominated global mutual funds. The limit is obviously $200,000 per person per financial year. Practically, you remit funds to a gift city foreign currency account, and instead of guessing which US stocks you want to buy yourself, you invest in professionally managed global equity, debt, or hybrid mutual funds. If your child is 10 to 12 years away from college, allocate more towards these global equity funds. As the admission letter gets closer, systematically shift it to USD debt or money market funds to protect your capital. But here's what many don't tell you. These are treated as foreign assets. You must declare them in your capital gains taxation, which is followed by foreign funds rules. This is not about chasing returns. It is about matching currency with liability. Because, when fees and the invoice will arrive in US dollars, the last thing you want to realize is rupee-based investments, your SIPs actually grew, but rupee fell faster, so now you have a shortfall. Hi, I'm Sneha Vasudev, your certified financial planner, and yes, I'm SEBI registered. A quick disclaimer. This video is generic in nature and is meant to give you a well overview understanding of your child's education financial planning. It is not an investment advice, nor is it a recommendation to buy or avoid a specific product. Every family's financial situation is very different, and planning should be done based on individual stocks and goals, and depending on your risk appetite as well. I'm hosting a child's education week from 16th to 20th of February inside my Wealth Learning Network, where we will dig deeper into goal calculation, product structure, corpus building, strategies, and risk protection. Also, please note we do not run any free Telegram or WhatsApp groups. Any such claims are false. This network is structured, control access, and strictly by invitation only once you fill in the form mentioned below. All the details are provided in the description box below. Open any AMC fact sheet and you will see emotionally powerful names like Children's Gift Fund, Child Care Fund, Children's Benefit Fund, Children's Career Fund, or Young Citizen Fund. And they all sound like they are specially engineered for your child's future. But here is what most investors don't pause to understand. The word child is a positioning strategy, not a separate investment category. These are SEBI-classified solution-oriented schemes, and most of them come with a lock-in of 5 years or till your child turns 18, whichever is earlier. Not because they guarantee higher returns, but because they enforce some sort of discipline in you. Strip away the names, and what you will find underneath is either an equity-heavy portfolio, a hybrid allocation, or a conservative debt-oriented fund. The returns are not magical, not guaranteed, not insulated from volatility. An equity-oriented child fund will rise and fall exactly like a diversified equity fund because the fund manager is still selecting stocks and managing allocation based on market conditions, not your child's report card. Yes, you can invest in your child's name, in the name of a minor, with yourself as a guardian, and the folio legally transfers to your child when he turns 18. This is where clarity matters. You do not need a fund with a child name in it as a title. A well-known chosen flexi-cap, index fund, multi-cap fund, or a balanced advantage fund aligned to your timeline can create the exact same outcome, often with more liquidity and lower cost. If the goal is 12 to 15 years away, equity allocation matters more than branding. If the goal is 5 years away, risk management matters more than the label. The child is the purpose. The mutual fund is just a vehicle. The vehicle should be selected for engine quality and not a sticker on the bonnet.